Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I'll be reviewing a subscriber's portfolio, going through each and every stock and my thoughts on them. Once I've reviewed every stock, I'll give you my overall thoughts on the portfolio and if I would make any changes. Today's portfolio is from a long-term subscriber and friend called Dom. He has his own YouTube channel, so I've left the link to it in the description down below, so please go check him out. Dom is from Austria and has a portfolio valued at just over 20,000 euros. He is 36 years old and started investing a couple of years ago, but in my opinion still has plenty of time left in the market, so I'd still be very optimistic. As they say, better late than never. He works reduced hours at his job because the time he has with his kids when they are young is more precious than anything in the world. I personally don't have any kids, but I couldn't agree more. If you can afford to financially sustain yourself while dropping work hours, I'm all for it, so good on you, Dom. He actually still manages to invest on a consistent basis. He has 85 euros weekly auto buys, which equates to a minimum of 340 euros per month. Whenever he has some extra money, it goes into the portfolio alongside reinvesting any dividend payments he does receive. His weekly buys are as follows. He puts 25 euros into VUSA, 25 euros into VHYL, 10 euros into JEPG, and then 5 euros into MasterCard, Visa, Google, Amazon, and Microsoft. The goal of the portfolio is to have a strong core holding of the portfolio in ETFs around 40 to 50%, and he loves dividend growth stocks and also finds that they are very motivating over the longer term to see those dividend payments increasing, and it keeps him wanting to invest in the market. His approach is to have a mix of high yield with the income ETFs and REITs, and also a lot of dividend growth. The long-term goal is to cover most of his fixed costs with dividends by the age of 50, which is in 14 years' time. He would love to completely live off them one day, but feels he doesn't contribute enough right now. Having said this though, never say never. You don't know, if you stay consistent in the market, you could see that in the future. The only stock he's looking to sell out of in the portfolio right now is his UPS position once it's back in the green. As we can see on screen now, his portfolio is just over 22,000 euros and he has seen a 12% gain in the portfolio since starting it back in 2021. Now let's have a look at the different holdings within the portfolio. The first stock in Dom's portfolio is the iShares Global Selective Dividend 100 ETF, stock ticker SDGPEX. It is his biggest allocation at just under 10% of the portfolio and one that's performed pretty well, being up over 12%. The Global Select Dividend 100 Index comprises 100 high dividend yielding stocks from developed markets selected based on historical dividend yields. The index includes 40 companies from the Americas and 30 from each of Europe and then Asia/Pacific regions. It currently boasts a yield at 4.84% with a 5-year dividend growth rate at over 7%. This actually isn't a stock I'm familiar with, as it's a European focused stock, so for myself being a UK based investor, it would mean I'd have to pay withholding tax on it, so I prefer stocks that are listed on the London Stock Exchange. But for Dom, as I've already mentioned, he is based in Austria, so a European ETF does make sense. The top three holdings within this ETF are SITC at National at 4.9%, NatWest at 2.5%, and HSBC at 2.3%. The ETF is suitable if you're seeking regular income from high dividend yielding stocks across developed markets. However, it's essential to consider potential risks, such as exposure to distressed companies offering higher dividends to attract investors, which may lead to a higher risk relative to returns. And personally, I think there are less risky ETFs available on the market that could offer better returns in the long run. The next stock in Dom's portfolio is another ETF, and this one is just under 9% of the portfolio. It is a very popular one over in the US due to its consistent monthly dividend payments at a high yield. Something to note is that this is the UK version of JEPQ and has only been on the market since October last year, so it doesn't have quite the same yield as the US version yet. Having said this, it still yields over 6% and it tracks the Nasdaq 100 index to provide a consistent income stream. It is actively managed by JP Morgan Asset Management, SARL. The ETF combines active equity selection with a systemic options overlay strategy. The ETF aims to provide consistent monthly income to investors by distributing premiums received from selling call options alongside dividends from the underlying equities. It's one of the more stable ETFs that distribute premiums through selling option calls, although I wouldn't want to see lots of these types of ETFs in the portfolio due to the lower growth aspect and higher risk. I do think it's an acceptable position in the portfolio at this size, especially as one of Dom's main goals is to have good dividend paying stocks. It is currently down nearly 12% in the portfolio though, so one for him to consider. Next up in the portfolio is Microsoft, stock ticker MSFT, being just over 8% of the portfolio. Dom is up a massive 44% on the position, which is very impressive considering they have had a tough time lately. Microsoft stock represents ownership in Microsoft Corporation, one of the largest technology companies in the world. Microsoft is a global leader in software, cloud computing, artificial intelligence, and hardware. Over the past year, Microsoft has experienced a decline of about 15%, making it one of the underperforming stocks among major tech companies. This downturn is particularly attributed to reduced capital expenditures and concern over a potential consumer spending slowdown. However, analysts like Jill Lura from D.A. Davidson have recently upgraded Microsoft stock to a buy rating, increasing the price target to $450. A lot of analysts are very optimistic about the company. Despite the recent challenges, Microsoft's robust portfolio in cloud computing, artificial intelligence, and enterprise software continues to position it well for long-term growth. Although it only pays a very small dividend right now, I believe they will grow at a great rate over the long term, and I think an 8% allocation is very warranted for this company. At these current prices, it would be one I'd be looking to take advantage of and add to further. Next up in the portfolio is Alphabet, stock ticker GOOGL. It is his second biggest individual stock at 7.76% of the portfolio, but is unfortunately currently down 3% on the position. Alphabet is the parent company of Google and is a leading technology company known for its dominance in internet-related services and products. Analysts are very optimistic about Google, and I'm also a big fan of this stock being a bigger allocation in his own portfolio. For me, it's a great stock to continue adding to at current prices, especially being at under $170. Next up is Visa, stock ticker V, with a 6% allocation in the portfolio. As you can see, it's a stock that has had great gains for him, being up over 22%. And recently, Visa has actually reached an all-time high over $356, reflecting strong investor confidence. Visa has reported a 10% increase in revenue to $9.5 billion, driven by robust holiday spending and a 9% rise in payment volumes. This stock is such a powerhouse, and from a dividend perspective, has a phenomenal growth rate at over 15% over the last 5 years. With them having such a low dividend payout ratio, only 21%, I can only see them continuing this strong growth rate in the coming years. Additionally, Visa's investment in artificial intelligence are expected to enhance payment security and operational efficiency, positioning the company well in the evolving fintech landscape. Overall, Visa's strong financial performance, strategic investment, and positive analyst outlook suggest a promising trajectory for the company's stock, and its position I really like in Dom's portfolio, especially being a bigger holding. We then have the only stock in Dom's portfolio that doesn't pay a dividend, and that is Amazon, stock ticker AMZN. This is also just over a 6% allocation in the portfolio, and owning Amazon in your portfolio could be a great choice, especially since Dom is seeking long-term growth. The company is involved in various high-growth industries. Amazon is the largest online retailer in the world with a vast market share, offering millions of products across countless categories. As e-commerce continues to grow globally, Amazon is well positioned to capture a significant share of that growth. Amazon's overall profitability is off the chart, and it provides a strong growth engine in a rapidly expanding industry. For me, Amazon is an attractive investment for those seeking long-term growth in e-commerce, cloud computing, and technological innovation. The company's dominance in digital retail, strong presence in cloud services through AWS, and ongoing initiatives in areas like AI, logistics, and smart home technology position it well for future expansion. Amazon offers investors a robust opportunity to benefit from a global leader in multi-high growth industries. If this company started paying a small dividend, then at the right price, I would definitely be adding it to my own personal portfolio. Next up in the portfolio is MasterCard, stock ticker MA, and it's another stock with a just over 6% allocation in the portfolio. Another strong performer being up over 12% and one that's very similar to Visa. MasterCard has recently reported a 16% increase in net revenue, reaching $7.49 billion. This was driven, similar to Visa, by robust consumer spending during the holiday season. Overall, MasterCard continues to show resilience and growth, supported by strategic acquisitions and partnerships, and despite facing some legal and competitive challenges, it does have a phenomenal dividend growth rate at 13.7% over the last 5 years, and a very low payout ratio similar to Visa, actually lower than Visa's at only 19%. It's another position that I really like in Dom's portfolio, and I don't mind owning both Visa and MasterCard, even though they are quite similar stocks. So far, I'm really impressed with Dom's portfolio. We then have another ETF in the portfolio, being the Vanguard FTSE All World High Dividend Yield ETF, stock ticker VHYL. This ETF has a 6% allocation in the portfolio and has a dividend yield over 3%. The ETF has quite a poor 5-year dividend growth rate, sitting at only 2.19%, and the ETF holds large and mid-cap companies from developed and emerging markets known for paying higher than average dividends, excluding real estate investment trusts. With Dom already having a couple other dividend-focused ETFs in the portfolio, I'm not sure on the need for this particular one, especially with its below average growth rate. Having said this, the next ETF in the portfolio is one I'm a huge fan of. That is none other than the Vanguard S&P 500 ETF, stock ticker VUSA. This is actually just under 6% of Dom's portfolio, and the S&P 500 is a great ETF because it offers low cost, diversified exposure to the 500 largest US companies, making it an easy way to invest in the US stock market. With a low expense ratio, only 0.07%, strong historical performance, and regular dividend payouts, it's ideal for long-term passive investors like Dom. Its high liquidity and UCITS compliance also makes it tax efficient and accessible for European and UK investors. Next up is the trusty old monthly dividend payer. That is none other than Realty Income, stock ticker O. This stock is around 5.7% of his portfolio and is currently down 3% on the position. Although they pay a very tasty 5+% dividend yield, they have a very poor dividend growth rate, and for me, I really struggle to see much growth with this stock, and I think there are much better options out there that offer better capital appreciation and dividend growth, especially with Dom having a longer time horizon in the stock market. Don't get me wrong, if you're wanting safe, solid, consistent dividend payments to live off right now, then this company is a great shout, but I much prefer the next stock in his portfolio for one in the REIT industry with a much better growth potential. That stock is none other than Vici Properties, and it's a 5.5% allocation in Dom's portfolio. I prefer this REIT because they have a much healthier dividend growth rate, sitting at 6.6% over the last 5 years, compared to only 3.12% over the last 5 years for Realty Income. Not only this, when looking at the share price over the last 5 years, Vici has seen a great return at over 96% compared to only 2% for Realty Income, highlighting further why I personally much prefer this stock. He has another 8 positions in the portfolio that I won't go into too much detail on, but I do want to say that I really like the look of the majority of them, and overall I want to say Dom has done such a brilliant job when it comes to picking stocks, especially ones that align with his own personal portfolio goals. So what does this mean? Well, overall, I really like Dom's portfolio. I think he has a great mix of ETFs and stocks. Specifically, I think he has a great blend of growth stocks and income stocks, with a good portion of the portfolio being allocated to ETFs. I'm a huge fan of the allocation split between all of his stocks, especially having bigger positions in Microsoft, Google, Visa, Amazon, and MasterCard. One thing I do think Dom could tidy up in his portfolio is his ETFs. He currently has 5 ETFs in the portfolio, and 4 of these being more geared towards income focus. I personally would merge these ETFs and hold 1 or 2 income focus ETFs, and then add the capital from the other ones he sells to the remaining income ETFs, and add some of that capital into his growth ETF, the Vanguard S&P 500. While we are already on the topic of ETFs, I think regardless of if he merges the ETFs or not, I would strongly recommend making Vanguard S&P 500 ETF a bigger holding in the portfolio. For me, this ETF should be one of the main holdings and should be at least 10% of the portfolio. Ideally, I like to see no less than 30% of the entire portfolio in ETFs, which Dom actually already has, so this is great to see. If you do remember though, he did mention that he personally wants a 40 to 50% allocation into ETFs within his portfolio, so he does need to continue prioritizing his ETFs to make this possible. I know one of his main weekly auto buys is VUSA and VHYL, so I have no doubt it will hit this mark eventually. I also love the fact that Dom has every position above 2% in the portfolio, and I do really like his stock picking. I agree with Dom that the UPS stock is one that I'd look to sell out of. I do also think he could look to sell out of a couple others such as Realty Income and Coca-Cola. It's not that I see any major red flags with these companies, it's more so that there isn't enough green flags given Dom's time horizon. I know that Dom gets a lot of motivation when seeing his dividend income increase, so having the higher yielding stocks in there does make sense, and they aren't too overpowering, where I'd say he could do with making sure he has enough capital allocated towards growth. So overall, a great job here, Dom. What would I give this portfolio out of 10? Well, I have to admit, apart from tidying up the ETFs and having a slightly higher allocation in the S&P 500, I absolutely love this portfolio. It is a very manageable 19 holdings and is very well aligned with his own personal goals. I would give this portfolio overall an 8.6 out of 10. My main advice for Dom is to continue to consistently add to his portfolio on a weekly basis and try to always hold a 5% or bigger cash position to take advantage of any dips in the quality stocks that he already owns. Keep up the brilliant work, Dom. I'm very impressed. If you want to be featured in the next video like Dom has today, then please leave a comment on the video and send me a message on X at the Geordie Pig, answering all the relevant questions I have in the description below. Thanks for watching. Until next time, keep compounding and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.